Well, those energy prices take absolutely no pressure off inflation here, as we've been talking about. Overnight, the consumer price index for February in the United States came in at 6%, down from a peak of 9.1% in June last year. And that adds to the suggestion that the Federal Reserve will ease back on its big rate increases. Su-Lin is the Chief Economist with RBC Capital Markets and joins me now. Su-Lin, always great to chat to you. Many thanks for your time.
Hi, Ross. Good afternoon.
So tell me about, you've just heard here about the energy prices rising and the concern about what takes place in Australia in regards to inflation. Money markets are pricing in a 0% chance of a rate rise from the Reserve Bank in April, but the inflation story's not over yet, is it?
No, it's not. I mean, there are some very early signs that inflation may have peaked. And we know, for example, that there are particular components of inflation that were disrupted by COVID, and supply chains have resumed a bit more normality, particularly with China opening up faster. And we do know that there are components of inflation that are starting to ease, and that's particularly on the goods side. But as you point out, there are other pressures that are still to come through, and that is evident in service sector inflation. And so while the goods side is starting to come down, service sector inflation is still rising when we have pressures from tight labour markets, from high utility prices, increasing rents. All of that feeds through on the services side, and that's where there's risk to inflation proving sticky. So while inflation may have peaked, service sector inflation is likely to keep rising. That's going to keep overall inflation still elevated, although coming down, and probably still well above the Reserve Bank's target all through the course of 2023.
Okay, so the Reserve Bank has actually moved its target on the timing of inflation going back to 2 to 3% several times. Is that of concern, or is that just simply the nature of the beast when you're trying to forecast these things in a moving world?
Yeah, look, there's lots going on and there's multiple factors that influenced inflation. But the key really to getting inflation lower from the side that the Reserve Bank can influence is to weaken demand, to soften demand enough, hopefully not tip the economy into recession, but enough so that consumers pull back on spending, businesses can't pass through higher costs, and key inflation metrics all head lower. But to do that, you really do need to weaken growth. You need to see the consumer pare back substantially, borrowing decline as well. And that's effectively what the Reserve Bank is trying to do by continuing to lift rates and tighten up those financial conditions. So it does move around a bit. It partly depends on how high the bank is prepared to take rates, and how much it's prepared to crunch the economy. And that's the balance. That's the narrow path that the governor talks about all the time. It is tricky, but we would argue not getting back into target and barely at 3% by mid-25, that's a long way. It does miss the inflation target for quite a long time, and you run the risk that inflation stays high and elevated and becomes entrenched. That's the risk here if you take that long to get inflation back towards target.
Okay, so take me to one other aspect of this, because as a result of SVB, it's now broadly expected that rates will not rise in April. But when they don't raise rates, or if they ease off or give a message of easing off, the Australian dollar falls. And because we buy so many goods from overseas, manufactured goods, the price of those all go up. So there's natural inflation that is brought into Australia as a result of a weaker Australian dollar caused by the interest rate settings of the Reserve Bank.
And that really goes to the point that we can only move so far out of cycle with the US and some of the larger global central banks. So we are part of this global central banking tightening and policy normalisation cycle. I think at this junction at the moment, particularly with SVB, really the question is more about the Fed and the US. How much will the Fed do? Is it prepared to hike next week? If it does it need to turn around and cut quickly? And so the relativities are really to the US. If they don't hike by as much, that takes some pressure off the RBA by the exchange rate mechanism. So a lot of this comes down to what you think the Fed may or may not do. Now, markets in the US are starting to price in cuts sooner by the Fed and lower terminal. We would argue the inflation dynamics in the US continue to argue for slightly higher rates over there, a more restrictive stance. So we think the Fed Reserve will probably follow through with another 25-point hike next week when it meets.
And just a very quick one, Su-Lin. The other aspect of this is that if Australia basically gets out of kilter with the United States, You can see their inflation rates coming down, but still not in their target. That's one of the issues that Australia's just got to keep watching.
It is. And, the key really is what's keeping inflation so high and sticky in the US. Yes, it's coming down, but core measures are still high. They're around 5.5%, well above the Fed's inflation target. And again, this is a reflection of tight labour markets, rising wages costs, some sticky elements. Now, some of that is common to Australia and other parts of the world. So yes, we are watching the US inflation dynamics closely.
Su-Lin Ong, the Chief Economist with RBC Capital Markets. Always good to have you in the program, Su-Lin. Many thanks for your time.
Thanks, Ross.